let's connect with Ajay Srivastava, who is the CEO at Dimensions Corporate Financial Services. Hi Ajay, good morning. Good to be
Good
speaking with
morning.
you.
Thank you.
The excitement is very much indeed in your voice, but Ajay, the markets are not looking that exciting indeed, because it's the Indian markets that are under tremendous pressure. We are now sub that 22,000 mark on the Nifty as well, and everybody has been just asking the question that till when this sell-off is expected to last. Help us with your reading on the markets and how much more pain is left in the markets right now.
You know how much more pain only the God and the brilliant analysts, which I can see everywhere, can tell you. I can't tell you how much pain is left, but I can certainly say one thing for sure, the fact that what you need to do with your portfolios. Forget the market. There's a lot of chatter happening now with the tariff war in abroad. And so therefore, a lot more that you look at in terms of internal dynamics are playing out on the negative side. But more importantly is the fact that we need to have a stop to FI selling. I think that's a first point when we're going to see a market reversal of mood, sentiment, and fundamentals. Until that doesn't happen, I think we can keep having short-term, rallies, short-term consolidations. But the key point to me is milestone is when do FIs stop to sell, and I think that's a more important point. Once the supply goes away from the market, you will see consolidation. You will see a thing, but I have only word of caution is that if you're looking for a price to go up and sell out in the next 3 to 6 months, that's not going to happen because at every stage of price rise, you will see supplies coming in. So this is a time to plan your portfolio based upon a year or so down the line, but certainly not to look at transitory changes to say I get into futures and I try to make money out of it. Won't happen. Milestone is FI to stop selling and come back to India.
Yeah, absolutely. And that's the question, Ajay, because now you're wondering how is it that you protect the profit that you're actually sitting on in your core portfolio? What's the message to those investors who are just wanting to just throw in the towel now?
I think this is a wrong time to throw in the towel, to be honest to me. If you've not sold till now, if you've not booked anything till now, this is not the time to sell. Yeah, I know some shares may go 4%, 5% here or there and all. But this is a time to hunker down and say, okay, if I bought good stocks, I need to hold on to them. If I have bad stocks to start with, I'm not talking about them, but if you got good stocks, you hold on to them. The problem is not holding on to the stocks. The problem is how do you generate a rate of return which exceeds your debt rate of return in the current year? And that's the challenge is going to be here. What parts of the market are going to be able to even give you a double-digit kind of low double-digit returns? Because that's what you get from debt. If you took at a REIT, it gives you 12 to 14% return today on the stock market. So your challenge is not going to be whether you sell down or not. Challenge is going to be what you hold on. Will it give a return or not? I am certainly not advocating any sale at this point of time in the key portfolio stocks and so on. And on the two assumptions, one, I think it's a good wake-up call to the government also to see that when you tinker around with regulatory, the way they happened, they went after futures, options, margins, you name it, it was a relentless onslaught on the capital market in spite of giving you so much fantastic service, your tax collections. You see the price, what happens in the end. Let the market do what it's supposed to do. Let people make money, let them lose money. I think the key thing is if the regulatory agencies go back to the way it were a year back in terms of capital market, one first step of revival would have taken place. Tax, you increased it. Now, that's not a sensible idea to do in a world competing for capital. That's what needs to be looked at. Until these things don't happen, I think market revival is going to be very difficult on its own because we're heading into a lean economic season at this point of time. So good news is, I think we are done with selling by and large. I think we're the last legs of FI selling, maybe a week, 10 days, 15 days at best. I think that should not last more than that, whatever indications I'm getting. The sector most vulnerable, of course, is IT because it's held only by FIs by and large, not held by the locals. So I think that's the most vulnerable sector at this point in time. Domestic sector, PSUs, my goodness. If there ever was a chance to buy them again, you have got it now once more. Yes, and this is what we keep saying. PSU is cyclical. Now with the Ps of 3, 4, 5, 7, including the P metal companies, with dividend yields what they are, you are back in business, guys.
Absolutely, Ajay. I get your point on the regulatory moves, which did sort of backfire on the market sentiment. And I know also that the chatter is only getting louder now to cut long term capital gains tax, to try and make India attractive again, to get the FIIs back. But the fact of the matter is that there was an earnings slowdown as well. And the valuations were pricing in exorbitant earnings too. And that was the key trigger point. Tell me, when do you see a meaningful earnings revival come back?
That's why I said a good question, because the point remains that we are heading into lean season. So what do we do with the lean season, right? It's not going to have a revival in the lean season at all. That's not going to be possible. You'll have to wait for 6, 9 months. Having said that, a few sectors just show the resilience, which is unbelievable. The hospitality sector, it's just incredible what's happening in the sector. The rates are through the roof, availability is down to the dumps. And so, if you're invested in the hospitality sector, I think you're in good hands in spite of the slowdown that's happening. I think the biggest part of the slowdown has hit is the automobile sector. That's one which has been hit very badly. Auto ancillaries has been hit very badly because domestic and global slowdown. So I think sectorally, if you look at it, whether it's aviation or hospitality, that's doing remarkably well. The sector which is really cannot see a revival this year, in my view, is going to be real estate. The real estate bloodbath is the last chapter going to be unfolded into 2025, because that's what is waiting in the wings. Everybody who bought property is now wants to sell the property, and then you'll just see the impact unfolding as new releases start to come and no subscription happens. People start to sell up the property. So I think real estate sector is the most at risk today and should not see a revival. No need to worry about hospitality sector is doing very well. Aviation is doing very well. Pharma is doing extremely well. No need to get pessimistic about it. And I think at these valuations, your capital goods stocks worth a look at this point. So, so more than the revival, it has always happened. You're right. We became irrationally exuberant. We are becoming irrationally pessimist at this point of time. World didn't end. World's not going to end tomorrow morning. We just, okay. So I think at this point, we're exactly where we were in the September, but across the pendulum to say everything is bad, sell out, get out, no revival possible. And that's what the market trigger needs. Complete capitulation in sentiment, emotion is what the market needs to swing back. And I think we are reaching that point the way I see the chatter on all the social media.
Right. So hopefully we reach that point sooner than later, so that you can see some sort of a revival in the markets. A very good morning to you, Ajay. Cheryl also joining in the
Good morning.
conversation. I wanted to understand about the banking names and the financials in particular, because they are becoming the mega hit in this sort of market, because everyone's talking that this is a time that you can look at banks, you can look at financials. But the stress still remains for the entire space, given the fact that deposit growth also has not seen a meaningful recovery.
I haven't owned a bank for the last 3 years, and I'm not owning a bank today. And the reason is very simple. In an economy growing 6 to 7%, I got 80 banks competing for my business. None of them differentiated to a large extent that I should be able to pinpoint and say, yes, they have been stable. But there's an old Hindi saying, "Jo dauda nahi, wo girega nahi." जब वो चला ही नहीं शेयर तो उसका, if it didn't go up in the rally, it has not come down in the same magnitude. So let it be so. But I think it will be the most underperforming sector among all, for the simple reason that their cost of raw material is going up. People, it's not going to be easy for them to get deposits. The customer base has gone into quality, into very bad quality at the end of the day, because every good company in good time, and this beauty of this Indian industry, they raise capital. 2024 is the year when every Indian company supported its balance sheet and raised money when it could at good valuation. So therefore, that segment does not need bank money. What segment needs bank money is unsecured loans, the poor quality of the creditors, the MSME who are struggling. I think that's a sector, and that's not where you want to lend to. So banks have a peculiar problem. Raw material is expensive, but their end product goes to the market which they don't want to lend to. They want to lend to people who don't want to borrow. That's not a very good recipe for, in a sense, of a capital or value creation for shareholders. So I think banks will struggle to create value. They're stable because I don't think you can sell anymore what they've already sold. Nobody owns the banks by and large of a decent portfolio. So yes, they will remain stable. Yes, they may outperform the market for a short period of time. But the fact is, whenever the revival happens, you will see the industry should do much better. Stocks should do much better than the bank stocks. Capital market stocks have seen a bloodbath. I think they will revive themselves. So I would still say banking should be low on your priority for capital allocation in spite of stability. You're not in the market to earn debt return. You're on the market to earn alpha returns, guys. So it's I would call not even a widow stock, because widow stock used to give dividends. These guys don't even do that.
Well, certainly, Ajay, we do take note of that, but that's actually the contrary view that you are having right now in the banking space versus the rest of the fund managers that we speak to. But let's talk about the PSU pack, because Ajay, you are saying that look at the valuations, look at the opportunity to get and chip in some money over there. And the last time we interacted with you, you were actually highlighting that there is value in select defense counters. So in this recent fall, is defense looking even more attractive to you right now? What's your latest take on this?
I think the latest is that metal looked the most attractive on the PSU chart, if you ask me, because that's the easiest way to convert money is metal. They're expanding. They're good companies by and large. They're just PSUs at the end of the day, and therefore the valuation is poor multiples. So I think metal companies and PSUs are a top on the agenda to buy. We have got a holding into them. The next, as I said, if you really want to get into cyclical mode, would be your PSU banks, and the last would be defense, because defense companies have such a long gestation, and you've seen the frustration of the Indian Air Force saying, guys, can you deliver some planes? PSU companies cannot deliver products. They can go and dig mines and dig alumina and sell alumina, but they can't produce a complex fighter jet. Can you imagine? They don't produce cars. So why would they produce a fighter jet? Would you keep, so I think it's a capability issue. Yes, our docks have done decent job, shipyards have done decent job, but at the end of the day, I still say the same thing. There's the efficiency required in a manufacturing sector. How do you expect to come from a kind of a PSU environment and PSU pay scales? So yes, there is a monopoly of defense companies. How long will it remain? We don't know. How much margin they'll get? We don't know. What order they can get and execute? We don't know. So it's so much of uncertainty coming to the fact that if you dig the alumina mine, you will get alumina no matter who the MD is. So that's why we said metal more favorite than even the defense today.
Metals and the capital market theme, that seems to be the bet right now. And yeah, if you're looking at more sedate returns, then perhaps banks. Ajay Srivastava, always good chatting with you. Thank you so much.
Thank you very much. You have a good day.
If you like this video, then like, share and subscribe to ET Now.